$40 in essentially that time. Tom, what's going on, do you think?
So basically, I think the story for Apple's been, what does life look like after the iPhone? So in a couple of weeks, we're going to have the new event for Apple where they're going to talk about their streaming video service. And the good news for investors is they're starting to see that there's more to Apple than the iPhone. And I think what they're doing in content's a great example. I'm not overly concerned about Elizabeth Warren's calls to break up any of the big tech companies. But yeah, I think you're starting to see life after after the iPhone, and it's encouraging. Are
you a fan of this theory that basically all profit growth over the next several years comes from services and wearables as opposed to unit?
Well, sure. I'm of the belief that they're going to, at some point, move on from the iPhone, which was 60% of their sales in their last fiscal year. Services is certainly one component. I really like what they're doing in healthcare, and it'll be interesting to see what their ultimate content play is here.
Mike, it seems to me like Apple has moved up 28% since that January 3rd low off the warning on no news. I mean,
pretty much.
If you hated him that day, then why don't you hate him today? So what does that say about either the turnaround in sentiment or, I don't know?
I think it's an extreme version of what's gone on with the broader market. So obviously, it was Apple's high was higher than the market back last summer, and its low was lower. And in terms of the dramatic moves, so I do think you had this purge of investors who basically had been complacent in September and got desperate in December and January. And then what happened? We had an under-owned stock that all of a sudden looked very cheap again, based on just steady state earnings. And I do think right now the trade has been okay. Probably the downgrades to iPhone volumes and to earnings estimates, maybe they've ceased and they're stabilized right now. I don't think the stock is that much cheaper today than it was a year ago. As of a year ago, the stock was 1% lower. And earnings estimates for this fiscal year and next fiscal year are down 9 and 11%. So essentially, people have just kind of come to terms with that. And I think there's also, you look at that chart and you say, well, there's room for people to rebuild positions in here, rebuild exposure to the stock before you even start talking about getting back to the old highs above 220.
Tom, I realize Senator Warren's calls to break up Apple, among other tech companies, may seem a little unlikely to happen, at least at this stage of the game. But Apple is still dealing with this case in front of the Supreme Court, which involves the App Store. So is that a real risk here for investors?
So the reason I think it's not a risk is basically Google and Android. So if Apple were the truly only store in town when it comes to buying apps, I think that'd be more of a problem. But Android is the largest operating system, mobile operating system. There's a lot of smartphones that are sold that aren't theirs. And then I would add to your points on Apple, what's happened since they pre-announced is that we're seeing that they're not alone as far as slowing smartphone sales, and they weren't the only one to experience challenges in China in the December quarter.
So, Tom, I wonder, because I connect the Elizabeth Warren breakup calls, because she specifically cited the App Store, with what Daniel Ek just put out from Spotify, specifically saying it's unfair that Apple, on the one hand, is charging us this 30% to be in the App Store, and then, they're depressing our ability to compete with them in terms of profit, directly versus Apple Music. In Europe, in the EU, that argument has a whole different and arguably better legal basis than it does in the U.S. So given that the argument on Apple now is about services, why isn't there more of a risk calculation around how this shakes out? Because Netflix, arguably, is doing much the same thing, putting pressure on Apple.
So I would argue that Netflix and Amazon are really two good examples of how to get around Apple's tax. You think about, for example, you want to buy content to watch on Amazon via Apple's app. You essentially have to go straight to Amazon, and you have to circumvent Apple. So I do think that the App Store is still an important means for downloads and for customer signups for services like Spotify. But I do think Amazon's a great example of companies that have found ways to get around Apple's tax.
Talking about what we may hear on the 25th, that'll be big news. But also springtime is when they start to talk about returns to shareholders.
Sure.
I wonder if you think strategically they make changes to that plan.
Yeah, I don't know if they're necessarily going to, bow to this scrutiny of buybacks. I wouldn't think so. I mean, Apple is so extraordinary. It's kind of such an exception in so many ways in terms of the absolute volume of cash that the company has and their stated intention of getting to a zero net cash position. And it's not as if they've crimped on R&D and capital spending. You can actually look at their financials over the last several years, and they've actually done, there's enough to go around for everything, I guess is the point. So in terms of capital return, I would be surprised if they had a radical new message on that. In terms of the streaming, it's interesting. I think it's all about sentiment and how people choose to view the company. It's a kind of an eye of the beholder situation. If that's another leg of this services story, okay, fine. But I think Apple builds these things so slowly, right? They kind of say, we think we have our plan. We're going to let it build over time. We're not going to necessarily say we're grabbing for a lot of market share.
They've never been a first strike player.
That's exactly.
In just about anything, right, Tom?
Exactly. So I also don't expect anything magical on buybacks, but I do think that buybacks is what's held up the stock.
Oh, they've been in the market.
Yeah,
right?
even when times are very tough. And then what I wanted to point out was we think about House of Cards, Orange is the New Black for Netflix, but really their first original series was Lillehammer. So Netflix did start slow also.
Stevie Van Zandt, right?
Expectations are low for Apple.
What I also found interesting, Merrill's upgrade of the stock this week had an interesting chart in there, which showed that it's actually, the stock seems to correlate when total gross profit in dollar terms starts to grow again, which they're predicting happens in the second half of this year, as opposed to strictly earnings per share. Yes, earnings per share kind of holds up the stock, but in terms of when it starts to perform better, it's not really the buyback story. It's when they're actually pulling more money in the door.
That sounds like a chart for you for the telestrator on closing bell, just to say. Tom, going back to the point that Mike just made, and I think is a key one for investors, is how should they be valuing the stock right now? Because, yes, it might be trying to shift away from iPhones and more into services, especially with the launch of these new potential streaming services platforms on the 25th. Should they be thinking about it as a consumer goods company or more as an internet software company as they move towards services?
So I still think of them, I guess, as kind of a combination platter of hardware and software. Historically, I like to think about Apple on a free cash flow yield basis. When it gets to that 10% free cash flow yield in the out year, it's kind of the hold your nose and buy type moment for Apple. I think that the challenge, looking at PE, for example, is that you're going to see continued pressure there as they rotate away from the smartphone into more services, into more opportunities. So I tend to focus a lot on their cash flow.